So ladies and gentlemen, we got them. We got the bankers. So there was the Volcker Rule. It was in the Dodd-Frank bill. Now, Dodd-Frank passed approximately 28 years ago. Not quite, but it's been a while. But they hadn't implemented the Volcker Rule yet. But here it comes, the Volcker Rule. Now, what is it? Okay, so this is very important because what the banks have been doing so far is they've been gambling with our money. So they deposit our money and they say, this is money we have on hand. Now we're going to do our own trading and we're going to take our own risk. And when we make that money, of course, we're going to give it back to the depositor. Of course they don't give it back to you. They gamble with your money and then they keep the winnings. Now, if they crash, oops, either your money's gone, and then we've got the FDIC to protect a certain amount of it, of course, or the taxpayers have to step in, either through the FDIC or on a mass scale like they did in 2008. So the Volcker Rule says you can't gamble with the money. If you want to make markets, which is you're an investment bank and you've got to make a deal for both sides, two different sides come to you, well then you can do that, right? But you can't gamble with the money, especially depositor money. All right, great. And in fact, the president was very happy about this. He said the Volcker Rule will make it illegal for firms to use government-insured money to make speculative bets that threaten the entire financial system and demand a new era of accountability from CEOs who must sign off on their firm's practices. Well, that sounds terrific. Problem solved. Especially because, remember, it's not just it's the depositors' money that they use as some of their collateral, but they're also getting government-backed loans at incredibly low rates. And to be able to use that for gambling seems outrageous as well. All right, so Huffington Post reports on it passing. They explain in the first sentence, big Wall Street banks face an uneasy future after U.S. regulators on Tuesday finalized the Volcker Rule, a measure that attempts to curtail big bets on certain financial instruments. In the second sentence, they say, but in a potential concession, the banks themselves largely will be responsible for determining whether they're in compliance. Okay, well, Volcker Rule, it was nice knowing you. How do they say this with a straight face? How do they pass these laws as if they matter? All right, let me give you more horrifying details. Officials said the final rule attempts to straddle the line, of course, it's Obama, between banning so-called proprietary trading by banks for their own account, but preserving big banks' abilities to hedge their risks and buy and sell securities in order to serve their customers, otherwise known as market making. So that's what I was talking about. Market making is perfectly normal and reasonable, what a bank should do, right? Now, they use it as an excuse. Oh, I need to hedge. Like, for example, the London whale, the one that lost $6 billion for JP Morgan, it was supposed to be hedging against other risks. When they said, hey, what are you hedging for? They're like, ah. No, they were just betting to make more money, and they lost the bet. If they'd won the bet, they'd all have taken extra tens of millions of dollars home. They lost the bet, nah, shareholders got tweaked a little bit, and none of the executives, of course, had to give any of the money back. No. They get to keep the money and go home with it. So in this case, apparently the banks are going to decide what's proprietary trading or not. They continue. The regulators didn't draw really bright lines for hedging or market making. This thing is one giant loophole if it's badly implemented. And that's Policy Director for Americans for Financial Reform. Now, what do you think? Is it going to be properly implemented, or could it turn into one giant loophole? Furthermore, Huffington Post explains, but the establishment of parameters that ultimately will determine whether banks are complying with the rule was left to the banks themselves. The rule also relies on the banks to tell regulators whether their trading practices, as they define them, comply with its provisions. Come on, man, just when you thought it couldn't get any more laughable. The banks will tell the regulators, this is what I have decided the rules should be, and I will also tell you whether I'm complying or not with my own rules. Well, are you not merciful? We really appreciate that. This seems like a really tough rule. Ooh, the banks must be shaky in their boots. In fact, I checked the stock market today, and it turns out the price for the banks, it went up. It didn't go down. They were like, oh my God, if they do the Volcker Rule, it'll crash the markets. The banks, nobody will want to invest in the banks. Huh, that's funny, because their prices either were stable or went up today. All right, one more terrifying detail. The final rule left open the possibility that banks may count other banks as their customers. casting doubt on potential effectiveness of a measure intended to help determine whether banks are trading to benefit their own bottom lines or the benefit of their clients. Now that gets into the weeds a little bit, but it's really important. When I read that sentence, I was like, Dodd-Frank is useless. The Volcker Rule has become a joke. And by the way, if you don't know, Volcker himself, the guy it was named for, backed away from it in the middle of this talk about how to implement it and said this has become a joke, and he just walked away saying this isn't the Volcker Rule. This is like a ridiculous fig leaf put in to pretend you're doing something when in reality you aren't doing anything. Now, I gave you this sentence in the weeds. Why? Now look, again, if you're making a trade on behalf of your client, well, that's what investment banking is supposed to do, right? But the banks, pretending that they're making trades on behalf of clients, make trades for themselves that are just wild gambles, right? Who do they make those trades with? Other banks. So if you consider trades with other banks for you as customers, then there is no Volcker Rule. Then it doesn't even exist, let alone the joke of an implementation and regulation of it, right? So that means they can do any gambling they want. This is Washington 101, where they pretend to fix the problem and then they do absolutely nothing. And there's one final piece of it. One of the people quoted in the story said, well, now it's on the regulators, so if anything goes wrong, I guess it's the fault of the regulators. Perfect. So the banks fix the rules so there is no regulation, and when they crash it, they'll turn around and say, you see, there was too much regulation. That's Obama administration 101. Change on the outside, continuity on the inside, and when you go further right and things get screwed up, then the right wing will say, you see, we went too far left. So in some ways, this has been even more damaging than doing nothing.